All right. Learning objective 3. Long-term debt. How to price the debt and then how to account for it. All right, first of all, what are bonds? Well, bonds are nothing more than a long-term promissory note. Each bond generally has a par value of 1,000. The bonds are generally sold in an issue, and we'll talk about how the bonds are priced. So usually when you have a bond issue, bonds are sold, there are multiple bonds. So for example, if you have a bond issue of 10 bonds, par value is usually 1,000. The bond issue is 10,000. Each one of these bonds is an individual promissory note. Each bond is like an individual note. So rather than going to the bank and borrowing 10,000 on one note, you go into the market and you issue bonds to bondholders. The bondholders are actually investors, but they're really lending you money. So if you go out right now and buy a bond, you're actually lending the corporation money. So rather than borrowing from a bank the full 10,000, the individual promissory notes, the individual bonds, can be sold to 10 different people. So you have 10 different lenders. Now, the relationship between the corporation and the bondholders has to be set up with a contract. We'll talk more about that as we move along in the curriculum. But those are known as bond indentures. They're contracts between the bondholder and the corporation. Now, here is the terminology, and you've got to get this down. Par value, the face value, that is the amount that's stated on the bond certificate. $1 par. The interest rate that we call the stated rate, the face rate, the nominal rate, the cash interest rate, coupon rate, stated rate, is on the bond certificate. You also have the maturity date, you'd also have the payment terms, but the other rate that you really have to keep in mind is the market rate. And the effective rate is the rate that we will use to price the bond. So the contract rate, coupon, stated rate, whatever it is, this relationship will determine how the bonds are priced. So again, the coupon rate is stated in the bond contract. This is used to calculate the cash interest. So now we're going to start thinking about the calculator, so that this is used for the payment. That's the rate that we use to calculate the coupon or the cash interest, or the annual interest. The market rate is the rate we use to price the bond. And why? Bonds are always priced to yield the market, so that no matter what rate is on the bond itself, the bonds will be priced so that you earn the market rate. The market rate is the rate on a similar debt instrument. A similar instrument with similar risk. So if you go in the market and your bonds, you want to sell bonds, you want to borrow, your bonds are offering 8%, but everybody else in the market is paying 10. Your bonds aren't going to sell for par value. The price is going to drop. Your bonds are inferior. You have to think of your bonds as a product. So if your product is offering 8%, but everyone else is giving 10, those bonds will have to drop in price. Now, when the bonds drop in price, you'll find out that what's your effective cost of borrowing? It's going to be the market rate. So you as an investor will always earn the market rate, and a corporation will always incur the market rate of interest. And I'll get rid of these. Okay. So again, the periodic interest, the payment, is usually semi-annual, and we know that's on the bond certificate. We also know, and I already said some of this, the par value is the single sum, and the par value right here is the future value. That's the face value or the future value on the bond, and that's printed on the bond certificate. Now, the difference between the two, and I think we've done some of this, at least I know I put this up on Blackboard. We know that the payment is an annuity, and the future value is a single sum. So what we need to do is just dig in a little bit more to think about how a bond is going to work. And basically what we've got is a timeline. M is your maturity date. So if you buy a bond today, that bond is going to make periodic payments and it's also going to give you, at maturity, the face value. Now, the bond price, and you'll see this in finance, you may even be seeing this in economics, the bond price, like any other asset, is the sum of the present values of those future cash flows. That's the value of this asset. So, when you price the bond, we have to know how many periods, we have to know the payment and the future value. And we're going to discount this at the market rate of interest. So bonds will be priced at the market rate of interest. And the sum of those present values is the bond price. The bond price is the sum of the present values. You have a present value of an amount or a single sum. And the present value of an ordinary annuity. So the bond price is the sum of the present values of those future cash flows. Now, what the bond will sell for will depend on the relationship between the market rate and the stated rate. We'll see a lot of examples in just a second. But here's that relationship. Of course, the face value of the bond is fixed. The face value of the bond is fixed at $1,000 or $10,000, whatever the issue is. The stated rate is also fixed on the bond, but the market rate will fluctuate. Now, there is an inverse relationship between bond prices and market rates. There's an inverse relationship between bond prices and market rates. So that to give you an idea, and I know I probably have this later on, so if you go to market on a date, you got 8% bonds. You go in the market at a date when the rate of interest anywhere else, so I walk in here and I'm the first person in and I tell you I got 8% bonds. Next person comes in, I got 8% bonds. Everybody's got 8% bonds, so there's an equilibrium. You're going to pay for my bonds, you're going to pay par value. All right, so you're willing, my product is no better than any others, no worse, so you'll pay par value. On the other hand, if I walk in here with 8% bonds, well, you go to the next room and you can get 10% in the market. Now my product is inferior. And someone will say, you know what? I'm not going to give you $1,000. I'll give you $9.95. Someone else says, I'll give you $9.90. Wait a minute, I'll give you $9.80. The price drops until an equilibrium is reached. And at that equilibrium, of course, the bonds sell at a discount. But at that equilibrium, I walk out of here with less money. Maybe you're going to give me like $800, and that $800 winds up giving me a cost of borrowing at 10%. So I'm going to borrow at 10%. Even though my bonds say 8, the fact that you gave me less money means that I have to absorb more of that cost. So for example, let's just assume and forget about the coupon interest, I'm going to have to pay back at maturity $1,000. We go in here and we start negotiating the price. My interest rate is lower than the market rate. What happens? I walk out of here with, let's say, $900. I still have to pay you back $1,000. So I usually give you the kind of like the liberal arts test. I walk to the other side of campus where there are no business courses, and I say to somebody, well, look, I know you don't have any degrees in business, but I'm going to borrow $900, but I got to pay you back $1,000. What would you call the difference? Interest. The discount is interest. So that raises my cost of borrowing from 8% to 10%. So I have to pay you back $1,000, even though I borrow $900. And that difference is additional interest. That additional interest expense is going to increase my cost of borrowing. And magically, it increases my cost of borrowing from 8 to 10%. Now, let's make sure we have the logic before we go to this premium. Does anyone have any problems with the logic? The logic is as follows. I walk in here with a bond that's going to give you 8%. You can get 10% anywhere else. You're not going to give me face value. You let me borrow $1,000, but you only give me $900. I still have to pay you back $1,000. Therefore, my cost of borrowing goes up. So the discount is additional interest. Now, of course, the accounting problem gets a little bit more difficult because when do I actually pay back that interest? At maturity. But we're not on a cash basis, so I have to accrue that interest every period. We call that discount amortization. So every period, I'm going to amortize the discount. So the discount will be amortized. So not only do I have a payment, now sometimes they don't have a payment because sometimes they're zero coupon bonds, but not only do I have a payment, but I also have discount amortization, which raises my cost of borrowing. So the bond will always yield the market rate regardless of the coupon. It's costing me 10% whether my bonds had a 10% coupon or not. Now, this, I mean, the rates we're using here are extremely, the spread is extremely large. The spread normally is not that large. I mean, if that really happened in practice, and I've seen some companies do this, I may actually pull the bond issue back. Normally, rates don't fluctuate that much. Right? So if I go to market, maybe several months before, I'm preparing the bond documents, I set my rate at, 8%. By the time I get to the market, what's it going to be? 8.01 or some kind of basis point differential. It's not going to be, that kind of a spread. It could, and it does happen when there's zero coupon, obviously, right? When there's no cash interest, you used to get a larger spread. All right, now, we'll see this again, but let me go to the next case. What if my bonds offer 8, anywhere else in the market, you get 6%. What happens? Now all of a sudden you say, hey, wait a minute, I'm getting 8% here. I'll give you 1,010. Somebody says, I'll give you 1,020. The price keeps getting driven up, and an equilibrium is reached. And in that equilibrium, if you pay more than par value for the bond, your rate of interest is going to drop. And in my case, I'm actually better off because what happens now, I may walk out here with $1,200, but I only have to pay you back $1,000. So, the premium is interest savings. It reduces my cost of borrowing from 8 to from 8% to 6%. So my cost of borrowing drops. Actually, when you amortize this, it's almost like saying, well, you know what? I've got $200 more of your money. I'm going to use that to pay your first 2 interest payments, so I'm almost getting your interest payments free. So this does get amortized. To reduce interest expense. And that's the logic of the premium. I got more money than I have to pay you back. And as a result, I wind up with lower interest. My cost of borrowing drops. And that is the bond. And by the way, bond pricing is, now this is in the primary market when I'm first selling them. Secondary market works the same. Go to the newspapers today, and probably there are lots of bonds selling at premiums, with the Treasury note at 1.6%. I mean, I know that in our pension plans, we've got New Jersey bonds at like 6%. I mean, those things are at a huge premium. If I sold them now, or if my pension plan sold them, I can't. But if the New Jersey pension plan sells those bonds, we're going to get a huge premium on that because the market is like 1.6 on a Treasury note, corporate or government bond that's triple tax free. It's like almost 6%. That means it's kind of like a yield of about 7, right? Now, you go to sell it. Now, if you go in and buy bonds, like if you bought that bond, you're going to be paying a huge premium. you're going to be paying a huge premium. And in fact, if you go in right now to the bond market and buy a bond at face value, so if you buy a corporate bond that's paying 2% and you pay par for that bond, next month or next Fed meeting, they raise interest rates, that bond price is going to drop. Right? So right now, buying a bond, unless you're going to hold it long term, is going to probably backfire on you because it's going to drop in price when market rates go up. So there's an inverse relationship between bond prices and market rates, not only in the primary market, but in the secondary market. All right, now, got a few more minutes before we take our next break, so let's do a couple of problems. And by the way, when you do the present value, I know that next semester, when you take finance, we're going to do more of the formula derivations as well. And I did some of that online with you, what's the PV formula and all that. And then you use calculators also. So let's go to the next example. So now I'm going to do a par value example. So that, let's say that investors wish to value a bond with a face amount of $400,000. The coupon rate is 8%. Interest is payable semi-annually, and the bonds mature in 5 years. Now, once we move to a semi-annual, in this case, the market rate is 4%. Or the stated rate is 4%. Five years, compounded semi-annually, is 10 periods. What we want to do is calculate the bond interest. So the coupon interest, all right, they did a little bit differently. I'm taking it to 4%. So that's your payment. That's N. The 400,000 is the future value. And we know it's paid semi-annually. Now, what we need to do is figure out the market rate. If the market rate is 8%, it's the coupon rate. If the market rate is also 8, then we have enough to discount. Now, so I think I was trying to what I was trying to do on that video I posted on Blackboard, trying to show you that when you're working with the PV, first of all, this is an ordinary annuity, which means that the payments come at the end of the period. So make sure your calculator is not in beginning mode. So let me show you that one more time. If you look up on the screen here, it's got yours will say algebraic. I use the reverse Polish notation, the RPN. Nothing's on the screen. That means your calculator is in end mode. If you wanted it in beginning mode, the blue key and 7 moves the payments up to the beginning of the period. Sorry about that. Let me clear that. So it's G7. And you'll see the word begin. So if that's on there, what that does is it pushes the payments to the front. It front loads the payments like a lease, right? Payments are due at the beginning of the period. You don't want that, so now you go back to G8, which is begin. So just make sure your calculator is in beginning mode. So if you look across the top of that calculator, we've got everything we need there. And we should get the par value back. So we know that I is 4, it's the market rate. and it's 10 periods, not 10 years. Payment is the coupon interest, 16. Future value is 400,000. And just a comment I made during that video, got to make sure that payment and future value are the same sign. So I'm putting these in as positive. Those always have to be the same sign. And the present value is going to be negative in this case, but that's my variable. Now, I know I got, in this case, I could do this either with the tables or with the calculator. So if I do with the table, I know that this is the present value of an amount. So if we map this out, 10 is equal to n here. Okay, so the future value is an amount, a single payment at 10 years at 4%. That is the factor. Now, where do I get that factor from? If you want to use tables, it's up to you. I've got these tables on Blackboard. And I thought that, by the way, you don't have them in your book, which is interesting. Surprised. What you did, but you can always get them online. I would have to use table 6.2, the ones I gave you, and this is 4%. So if I look down the 4% column, it's right here, and I go down to 10. The factor is 0.67556. That's the present value of an amount factor. Now, as I said, in finance, we're going to be using the formula, so that's 1 over 1 plus I to the n, if you want to use the formula that you actually see there. So if I discount this separately, 0.67, that rounds a little bit more. I wind up with 270,226. That's for the lump sum amount. The payments, 16,000, those are an ordinary annuity. So what I have to do is go to table, in this case, 6.4, and look for the present value of an ordinary annuity. And that table is built off of the factors. As I said, that would be the annuity factor. And that's the PV of an amount factor. So in this case, the present value of an ordinary annuity, 4% for 10 periods, should be right here. That's 4, that's 5, where's 4? 4's right there, okay. So it's 8.110, yeah, 8.11090, and again, it's rounded. So if I discount the annuity, multiply 16,000 by 8.1109, and the present value there is 129,774, and the present value of course, has to be 400,000. Now, whether you use a calculator or whether you use the tables, you got to do a logic check. If I told you the market rate is 8%, the cash or the coupon rate is 8%, taking an exam, you better get the par value back. Can't have a discount or premium if the rates are the same. Now, of course, if you did this on the calculator, now let me just show you how this would work. I would always clear the register. Now, basically, if you wanted to, CLX means to clear the last variable you put in. That'll just clear the last entry. If you want to clear the register, it's the F, and you clear the register, so you make sure everything's out of there. All right, so now you get the register clear. All right, so now I would put in the future value, which is 400. I'll put in the 16,000, which is the payment. I've got 10, which is N. 4 is I, because it's semi-annual. And the PV is 400,000. Notice it comes out negative. Right? It's going to come out to be negative. So I want you to try that. I just want to be sure your calculators are set up properly. I'll do that again. But it's got to come out 400. All right, so let's make sure we try that again. All right, so you got to get the par value back. So I'm going to clear the register one more time. That's the gold key, CLX. So you got 400,000 on the future value. That's the principal amount. 16,000 is the payment, right? Whatever you see on the side of the board. 10 is N, 4 is I, PV is 400. Now, you're going to have to get used to this calculator, mainly in situations where you've got to solve for N or I or the payment. I mean, you can easily solve with the tables. And there are ways to solve for N or I. If you like math, it's called linear interpolation, if you want. But without that, you're going to have to use a financial calculator.
Why is the present value essentially equal to the future value?
Because the par value is equal to, because the interest rates are the same.
Oh. Okay.
So because the interest rates are the same, you're paying face value. Remember the logic, this is a product. You're not going to pay more or less for a product that's in equilibrium. So 400,000 is the price that you're willing to pay. And as I said, you've got to get that back. That's what you've got to get back if the market and the coupon rate are the same. Yep.
You said it's always going to be negative?
Well, yeah, let me go back to that point. On the, if you watch the video that I did for the PV, you've got to think about the following. It's, and by the way, I'm a little bit in error here because this has to be negative. All right, so here's the way it works. You're the investor. You pay 400,000 negative to get positive cash flows. That's the logic behind it. Now, if you're the corporation, you can make the present value positive, and the outflows, you owe somebody 16,000 plus the 400. You could do it that way too. But I'm just saying, be very careful. You get like this hideous error 5. I think you'll see it just, things spins around for about 15 minutes and it says error 5. Error 5 means that, for example, if you were trying to solve for the payment and you put these two in at the same sign, it would give you an error. PV's got to be negative if these two are positive. PV's positive when payment and future value are negative. So the logic is the way you see it here. Either you pay out money today to get cash flows in the future, you make an investment, or you borrow, that becomes positive, and you pay it out. All right, so I just wanted to give you, and here's the calculator, by the way. All right, market rate's 8%, there's your calculator. It's a different example? No. Is it? Should be the same. Yeah, it's the same. There's a typo in there too. Thanks. Today's a bad day, jeez. Having a rough one today. A lot of typos in there I didn't catch when I first went through this. All right, this should be, that should be 4 divided by, 8 divided by the market rate of interest. We'll make a note of that. I'll fix that at some point. Okay, so that's the calculator amount. All right. And that's exactly what we see across, a little different than ours, but any financial calculator will do that. So let's go to the discount case. And in this case, very similar to what I had up before, is that you had the same thing, you have the bonds with 400,000 at 4% stated rate, semi-annual, right? Semi-annual coupon rate, 16,000 is your payment. The market rate now is 10%. So now and by the way, you have to think of this, as I believe I said when I was going through that video with you, as your opportunity cost. That's what you're giving up to buy my bonds at 4. You give up 5%. And the maturity is 5 years. So we're going to go through the same exercise. The interest payment stays the same. So because the coupon rate is the same, and this is the interesting point, these bonds, and I mentioned the New Jersey bonds, those bonds are going to be all over the place. Like right now, their prices are way up because interest rates are low. Once interest rates start going up again, if interest rates hit the 5% on the tax-free market, those bonds sell for par again. Like right now, they're selling for a premium. So the 5% that we're getting in our pensions here does not change. That doesn't change. The tax-free interest does not change. What does change is the market price. So now, the present value, and we can use the tables if we want. So let's now go through this again. And I'm going to show you what it looks like on the table. The cash flows don't change. What changes is the discount rate. So instead of discounting this at 4%, you're discounting it at 5%, semi-annual. And just remember that anytime interest rates go up, present value drops. There's an inverse relationship. The longer you wait for your money, the higher the interest rate, the lower the PV. So when those rates go up, the PV is going to drop. Same thing here. Interest rate's going to go up. It's going to drop the present value of the annuity. If the interest rate goes up here, keeping N the same, that drops as well. So the higher the market rate, the lower the value on the bond. So now, to price these bonds, I'm now pricing them at 5% rather than 4%. 61391. And this is 7.72, 173. If you want to use the tables, let me know. Well, I'm assuming we're going to use calculators now. But if I use the table, the sum of the present value of the future cash flows or the value of any asset today, theoretically. So the 245, 564 is the present value of the principal, and 123, 548 is the present value of the interest. By the way, if this was a zero coupon bond, no coupon interest, this bond would sell for 245, 564. With the interest, this bond sells at 369, 112. Bond sells for a discount. The bond sells for a discount because the product is inferior. I can get 10% in the market. You're only giving me 8%. And the discount discount is $30,880. In other words, what's going to happen is that, forgetting about the cash interest, time period 0, time period 10, the problem now for me as the corporation is I'm going to borrow $369,112, but I still have to pay you back $400,000. So that discount is additional interest. Additional interest expense. So the $30,880 is additional interest expense. That interest increases the rate from 4% semi-annually to 5% semi-annually. That discount increases the rate from 8% annually to 10% annually. So my cost of borrowing goes up. So not only do I have to give you $16,000 every period, I also need to give you another $30,880 when the bonds mature. So the cost of borrowing goes up. Now, in theory, we paid in cash at that point, but we're going to amortize that bond. So each period, my interest is going to be $16,000 plus discount amortization. And we're going to see that later, that the interest is going to actually increase by the amount of that discount. So the discount amortized is going to increase that amount. All right, now let's try it on the calculator. So again, the only change in the variable, I got 400 as the future value. 16,000 is the payment. 10 is N. Now I goes to 5. 5 is I. And the PV, a little rounding there at 369, 113. They didn't show us the calculator, I'm sorry. 369, 112. Okay, now that means that you borrow 369, 112, got to pay back 400,000. So your cost of borrowing increased. Try it again if you didn't get it. Make sure you can get that number. Just want to be sure everyone's got the calculator set right, because sometimes if you don't get it, yep.
Does it matter what order you put it in?
No. Doesn't matter what order you put it in. The other good feature with this calculator versus, let's say, a Texas Instrument is that if any of those variables is 0, you don't have to put it in. So for example, if it's a 0 coupon bond and there's no interest payment, you don't have to put a 0 in. So any order. The last variable, of course, you solve for the P.
That's just not much.
Yep.
I know it's silly, but like on a test, would it, if we put 113, do we?
It doesn't matter.
Because it's like
I mean, there's a range. I mean, there's always a range of rounding.
Because I mean, I guess you could round down 12.
Yeah, it depends on how many variables you put in. If you use a table and you stopped here like
Okay.
7.72,
It might be.
you'll get a different. Everyone's going to get a little different number.
Okay.
I mean, a rounding error of a few dollars is not a big issue. All right, let's get some questions on the discount. We're going to do the debits and credits in a minute. Any questions on the discount? Anything on the discount at all? Did you get it? You okay? Yeah. All right, calculator's working. Anyone with any problems understanding that that discount is additional interest? I mean, the fact that you borrowed 369, 112, you have to pay back 400. That's the cost of borrowing. You only have, the other way to look at it is you only have the ability to use 369,112. That's all you have to use to get a rate of return, and you still got to pay back the 400. So your cost of borrowing is higher. And now, of course, in equilibrium, your cost of borrowing goes to 10% or 5% semi-annual. do one more and see if you have any questions. We're now going to go to a premium case. And as I described to you earlier, market rate is now going to be 6%. So you go to market with an 8% bond, market's only giving me 6. So semi-annually, you're going to give me 4, but the market rate is 3% semi-annually. That means that the bonds at 8% are more valuable or are in a greater demand. Demand is greater than supply, drives up the price, and that price will be above par. It'll sell at a premium. And again, it's a 3% semi-annual. And again, market rates are inversely related to bond prices. So in this case, what happens to the interest rate? Interest rate goes down. We expect the present values to go up. Market rates down, prices go up. So in this case, once again, the interest does not change. So I think what the authors are trying to make sure they get very clear in your mind, they don't care, we don't care what the market rates are. That bond contract is a legal document. And I've got to pay you $16,000 every 6 months. I don't care what the market rates are doing. So you're locked in to that rate. That's why a lot of people do what? What do people do with mortgages when market rates go down? They refinance them. So in a lot of cases, you'll see that corporations will refinance also. Right? So right now, if I've got a 6% bond, and those are also difficult for investors to understand sometimes, they buy a bond that's callable. If the bond is callable, the corporation can call it within a certain period of time. When they call it, they give you face value. So if I've got a 6% bond and those bonds are callable, take them right back, and I got to give them up. And now that corporation takes those 6% bonds, gets them off the market, and borrows at like 2%. So they refinance them. So again, this time the rates are now, market rates are lower, my bonds are more valuable. So in this case, again, if we do the PV, and I'll do this one more time with the tables. So in this case, the principal amount at 3%, the factor is going to be, in this case, with respect to the lower interest rate, the higher the present value, the factor goes up. Right, so you see the numbers there, present value of the principal, present value of the interest, bonds sell for 34,119, and that will happen. If, for example, if I wanted to sell, if I could sell the bonds in our pension plan with 5% tax-free right now with the market the way it is, if I happen to have 400,000 of those bonds, if I sold them right now, I'd be able to get a market price, let's say, way above the 400. And in this case, the premium is 34,119. And the premium is going to lower your interest cost from 8% to 6%. The premium will lower your interest cost from 8 to 6. Again, using the same kind of diagram here. I'm receiving $434,119, I only have to pay you back $400. So the premium is interest savings. And if you think about it, it's going to reduce my interest cost every year. I mean, the way I was told, maybe as a college freshman, that just look at it this way. If you've got to give somebody $16,000 in cash interest, almost more than two interest payments are coming out of the investor's own money. So your interest has to go down. Your cost of borrowing has to drop. If you're taking $34,119 more from investors than you have to pay them back, when I allocate this to each period, one way to look at it is I've got $34,119. I'm giving you $32,000 your first two periods. I'm giving you back your own money. Didn't cost me anything. So my interest has to go down. So the premium has to reduce the interest. Great. Now, of course, I want to try it on the calculator. So I'm clearing the register again. Don't forget the gold in CLX. Let's go through that one more time. So I'm going to punch in 400,000 as the future value. Payment never changes, 16. This time I is 3 and N is still 10 and the PV is 434, 120. A little different than this one as it is at 119. All right, so those are par, discount, premium cases. Once again, the calculator, make sure you get that if there's any problems with that. All right, now, questions. Let's see if we have any questions on any of the calculations. Anything on the theory here? Okay, we'll see more of this when we do the journal entries. It'll be easier to see. Okay, that premium, by the way, has to be amortized as well, just like a discount. So basically what I'm saying here is that, and we'll see that in just a minute, each period, it's $16,000 minus premium amortization. So your interest cost is going to drop. Your interest cost is going to drop. All right, now, before we summarize and then move on to a couple of questions and maybe even, then we will talk about amortization and the journal entries, of course. But before we do that, questions on the three examples, three kind of like baseline examples. All right, so to summarize, here are calculators, by the way, so we've already done financial calculator for the premium and for the discount. Okay, so what I want to do is go right here. Okay. So just remember, these are the same examples I had on the board before. As I said, I know we get to this. When the market rate and the coupon rate are the same, you've got the market's in equilibrium, so you pay face value. In the case where the market rate is higher, there is a discount because the product you're offering is inferior, and the demand, or I should say the supply of those bonds exceed the demand that drives the price down. The price settles to the point where you yield or pay the higher rate. And when the market rate is lower, your bonds yield a premium. They're a superior product in that sense that when you go to the market, the demand is greater than supply, and it drives the price up. And your effective cost of borrowing, as I've been trying to say with these diagrams, is going to be 160 in the case of a par value, because all you're going to pay effectively is 160. In the case of a discount, your interest goes up to 190,887. It's the sum of the payments plus the discount. That's your total expense. If it's a premium, it's the sum of the payments minus the premium. So if the bonds sell at par, your cost of borrowing is exactly equal to the coupon rate, or 160 in total. If it's a discount, it goes up. The discount is additional interest, so it's 190,887. And if it's a premium, it's going to be 125,879.